You ever sit there and wonder, am I actually doing okay with money, or am I way off? Yeah, that thought hits a lot of us. I'm Ken, and this is Mimi. I'm kind of an introvert, but I'm obsessed with money. By the end of this video, you'll know exactly how you stack up financially against the average people. Well, here's the number. According to the U.S. Bureau of Labor Statistics, the median full-time worker brings in about $1,196 a week, roughly $62,000 a year before taxes. Kinda lower than you thought, huh? Now picture Friday payday. You check your app, see that deposit, and for a second, you feel safe. Then the car insurance hits. Your phone bill auto-pays. Groceries swipe. A quick stop for coffee turns into a mini Target run. By Sunday night, you're staring at your balance like, where'd it all go? It's not that you're bad with money. Life just chews through cash fast. Here's the thing. More than half of workers live paycheck to paycheck. Some pick up DoorDash runs or sell stuff online just to fill gaps. I know a dad in Ohio who drives Lyft after his 9-to-5 just to keep a little buffer. That's not laziness. That's reality when prices keep creeping up while pay stays the same. So you might ask, Ken, if that's the middle, how's anyone supposed to save? That's the right question. Once you see the real number, you get why one income often feels thin, and you start looking at smart moves, cutting sneaky bills, building a side hustle that actually fits your life, so you can finally keep more of what you earn. But here's the twist we're about to hit. Take that $62,000 paycheck and stack it against what the average household actually spends in a year. That's when the gap smacks you in the face, and suddenly all that money stress makes sense. According to the Bureau of Labor Statistics Consumer Expenditure Survey, most households spend about $77,000 a year, more than $6,000 a month. No wonder it feels like you're running uphill. Picture it, you're in a small apartment in Phoenix. Rent eats a third of your income before you've even had breakfast. Then there's the car payment, insurance, gas, a quick grocery run, daycare, maybe a dog that keeps finding new ways to need the vet. Boom, your money's gone and the month's only half over. Here's the first thing you notice. It's not just the big stuff. It's the drip buys, drive-through coffee, streaming apps you forgot to cancel, groceries that keep creeping up a few cents each week. The second thing, most of us don't track every dollar. We just swipe. Ever checked your wallet halfway through the month and thought, how's it already that low? That's not just you. Almost everyone feels that pinch. It doesn't mean you're bad with money. It means the math is tight when your outflow beats your inflow. Key point. If the average family spends $15,000 more than a single median worker earns, it makes sense why two incomes, or at least a solid budget, can change everything. And wait until you see the next part. What people actually have set aside for a rainy day. Because, that's where the safety net, or the hole in it, really shows. The Federal Reserve says only about 55% of adults have enough cash to cover 3 months of bills, and if a $400 surprise hits, a flat tire, a dentist visit, your phone decides to take a swim, around 37% of people would have to borrow, sell something, or just skip it. Think about that. Ever seen an unexpected charge hit your card and felt your stomach drop? That's what so many people deal with all the time. Right now, the median emergency fund is only $600. 1 in 5 folks don't have a dime saved for a rainy day. So when life throws a curveball, and it always does, you're suddenly juggling cards, texting friends, or putting it off because you just can't cover it. Here's the thing. This isn't about being bad with money. It's about how fast little bills eat at your paycheck before you even get a chance to build a buffer. Even a small cushion changes everything. A few $100 can turn a, how am I going to pay for this moment into, okay, I've got it. But saving isn't the only problem. The next shocker hides inside almost every budget, and it's something we swipe, tap, or auto-pay without thinking. More than half of Americans, about 52%, live paycheck to paycheck according to a 2025 study from Ramsey Solutions. That's not just a headline, that's everyday life for millions. You get paid, you knock out the bills, maybe grab pizza on Friday, and by next week you're staring at the calendar, waiting for the next deposit to hit. And it sneaks up fast. 1 month you're fine, the next it's a birthday gift, Gas jumps a few bucks, a streaming app you forgot to cancel. None of it feels big, but together, they eat your whole check. Ever scroll through social and think, everyone else has this money thing nailed? Most people aren't sitting on piles of cash. They're juggling the same stuff you are. Key point: living close to the edge doesn't mean you're careless. It just means the margin's razor thin when prices climb faster than paychecks. And seeing that clearly isn't about scaring you. It's about giving you a map so you can plan your next move. And speaking of next moves, let's check out a number most people forget about. The one that quietly decides if you save money or hand it over in interest every month. That number? Your credit score. The little rating lenders peek at before they say yes or no, and what rate you'll get. Right now, the average FICO score in the US is about 715, according to Experian's latest report. Looks solid, huh? But here's the thing, it's just an average. Plenty of folks are higher, but a lot sit in the 500s or 600s, and that's where money leaks out. Think about it. A good score means cheaper loans, lower car payments, better mortgage deals. A weaker one? Every swipe costs more in the long run. It's like paying a bad credit tax, and you don't even see it on the receipt. Ever wonder why your friend's car payment is way smaller even though you bought the same model? Most times it's that number. Key point: knowing your score and keeping it healthy isn't about chasing a perfect 850. It's about not overpaying for stuff you already need. And now we've got to look at one of the sneakiest spots where interest really bites. The plastic sitting in your wallet. The average American's sitting on about $6,580 in credit card debt, according to TransUnion's report at the end of 2024. And get this, total balances across the country? Over $1.18 trillion. That's trillion with a T. Here's the sneaky part. The balance itself might look small. Maybe you owe a couple hundred this month, a few thousand next. But the interest? That's where it bites. Swipe today, pay it off later, and later ends up costing double if you're not careful. Picture it. You grab lunch, top off the tank, snag a last-minute gift. None of those feel huge. But throw 20% interest on top, and suddenly your $30 pizza is a $36 pizza if you let it ride. It's like the debt grows in the dark while you sleep. Key point: credit cards can be a handy tool or a trap. Use them for points or cash back. Great. Carry a balance, and you're just handing banks free money. And that's only one slice of the debt story. Let's zoom out and see how big the whole pile really is for the average person. If you stack up mortgages, car loans, student loans, credit cards, folks in the US with a credit score carry about $63,000 in total debt on average, according to USA Facts. And almost 70% of that is tied up in mortgages. That's a lot of weight to lug around every month. Some of it's good, like a home loan that can build equity. But a big chunk? It's stuff that just drains cash. Car loans, personal loans, balances that creep up because of interest. Think about that feeling. You get paid on Friday, but by Monday you've got payments waiting, ready to bite off pieces of your check. It's like trying to sprint with a backpack full of bricks. Key point: debt isn't always the villain, but unmanaged debt quietly eats your future. Every dollar you send to interest is a dollar you don't get to grow later. And speaking of later, let's look at what's really left once all the bills are peeled away. The number that shows what you own compared to what you owe. That number is called net worth. And for the middle household in America, it's about $176,500, according to the Federal Reserve's latest survey. Sounds pretty good at first, but look closer. Families in the top 10% have more than $1.6 million, while people under 35 sit around $31,000. Big gap, right? It's not about shaming anyone. It's about seeing the map for what it is. Most folks don't own yachts or giant stock accounts. They've got a used SUV, maybe a little equity in a starter home, some retirement money, and a pile of bills. Here's the thing. Wealth builds slow. If your net worth feels tiny right now, that's normal. The flip side? If you don't start stacking even small amounts, time slips fast. Key point: net worth isn't just a number on paper. It's the cushion that lets you breathe when life throws you a curveball, and it's what lets you choose how to spend your time later. So, you might ask, Ken, what's really holding people back from growing that number? Good question. Two big ones hide in almost every budget. The first is student loans. For folks who still owe, the median balance is around $20,000 to $25,000, and the average federal borrower is near $39,000. That's like driving around with a car-sized IOU strapped to your back. The second is car loans. Experian says the average payment on a new car is about $749 a month, and used cars land near $529. New loans run close to $42,000, with interest hovering around 7%, and terms that stretch almost 6 years. See how fast those two nibble at your savings? You think, oh, I can handle $300 here, $400 there. But they pile up, and the more you send to lenders, the less you get to keep for yourself. Here's the point. Loans aren't evil, they're tools. But when payments start squeezing everything else, they stop being tools and start feeling like anchors.
And there's one more anchor we've got to talk about. It's not really debt. It's the price tag on something so many people dream about owning. Ah, that dream? A house. And oh, the price can sting. Right now, the median home in the US costs about $438,000, according to data from Realtor.com and List with Clever. To afford that without housing eating your whole paycheck, a family should make around $123,000 a year, but the median household income is only $77,700. That's a gap of almost $45,000 between what people earn and what they'd need to buy comfortably. And even if you look at national averages, you'd have to spend about 45% of your income just to cover the mortgage, taxes, and insurance on a typical place. You feel that squeeze everywhere. Scrolling listings that climb each week, driving past for sale signs with numbers that make you gulp. Even renting isn't cheap, which is why so many people stay put or split a place way longer than they planned. Key point: housing isn't just shelter. It's the biggest lever in most budgets. The price decides if you're building equity or spending years chasing a payment you can barely handle. And once you see how housing crowds out cash, the next question pops up quick. With paychecks stretched and homes so pricey, how much are people actually setting aside for tomorrow? Here's the answer to that question. And it's a bit of a wake-up call. Across U.S. households, the median retirement savings is only about $87,000, according to the Survey of Consumer Finances. And nearly 1 in 4 adults who aren't retired yet? They've got zero saved. Zero. Put that in real life? Say you had $200,000 put away. Sounds big, right? But using the old 4% rule, that's only about $8,000 a year you can safely spend. That's not even rent in a lot of cities. And it makes sense why people stall. Paychecks barely stretch. You've got student loans, car notes, a house that costs way more than your parents' place. And somehow you're supposed to stash cash for a future that feels light years away. Key point: retirement isn't about chasing some magic number. It's about giving your future self choices. Even small, steady deposits now build a cushion so you can work because you want to, not because you have to. And since a lot of folks lean hard on one program to fill that gap, let's look at what they can actually expect from it.
That program? Social Security. The safety net almost everyone counts on. Right now, the average monthly benefit for a retired worker is about $2,008, according to the Social Security Administration's 2025 data. That's roughly $24,000 a year. It helps, sure, but it's not a full-blown retirement plan. Picture trying to cover rent, food, meds, maybe a little fun money, all on $2,000 a month. You'd be stretching every dollar, cutting extras, maybe even moving somewhere cheaper. That's the reality for millions of retirees who don't have much saved past that check. And honestly,
I don't think Social Security has a funding problem. It's more like Congress keeps dipping into the cookie jar. That's what makes people nervous about whether their money will still be there later. Here's the point. Social Security was meant to be a base, not the whole pie. If you've got savings or a pension, that monthly deposit is a nice layer. If you don't, it can leave you walking a financial tightrope in your later years. And speaking of tightropes, there's one more number we've got to hit. The part of your income most folks don't even talk about, but it quietly decides how much you keep and how fast you grow. That number is your personal saving rate, the slice of your income you actually keep. Right now, Americans save only about 4 to 5% of what they make, according to USA Facts. That's way under the old-school 10% rule people used to aim for. You see it everywhere. The paycheck lands, bills rush in, and before you know it, you toss a couple bucks into savings, if any, and call it good. It's not that people don't want to save, it's that everything else jumps the line first. Rent, food, car stuff, a birthday dinner, maybe a surprise vet bill. The tricky part? Saving feels optional until it isn't. The car breaks down, or you finally get a shot at that trip you've been dreaming about, and you wish you had a little cushion waiting. Here's the point. That rate isn't just a stat. It's a mirror. Even nudging it up by a % or two builds wiggle room. It gives you choices later instead of scrambling when life happens. And speaking of choices, let's pull it all together. All these numbers, paychecks, spending, debt, housing, saving, they're not random stats. They're puzzle pieces showing where you stand and what you can actually do about it. When you see them side by side, the picture gets clearer. You're not broken. The system's just tight. But once you know the pressure points, you can start making moves that give you space. And finally feel in control of your money instead of chasing it. Wait, don't bail now. Most people think one bank account is enough. Nope. That's the biggest financial mistake. Most wealthy people use 6 specific accounts to manage their money. I've tested the system myself. They're simple, powerful, and way easier to set up than you'd think. Click that next video right now, or I guarantee you'll wish you had 10 years from today.